building crashed for about 2 months as demand came away from the market in that March, April, early pandemic. And then builders were essentially playing catch up as demand poured into all these markets, both from a low starting point and taking their foots off the gas. And then when you add in all the supply chain issues, lumber mills shutting down, various delays from appliances or products from overseas, lead times turned from like 3 months to 6 months, markets that were 6 months or 12 months. There was all these homes that were working through the process, and they're all starting to come finished about now as demand's pulling out.
Hey friends, welcome back to the CarrotCast podcast. The second Tuesday of every month, we're bringing you Carrot's Market Harvest, where we're bringing you the real estate industry data and insights that matter. I'm your host, Brady Winder, and today I have with me Mr. Tyler Ford and Nik Scoolis. Welcome to the podcast, guys.
Hey, Brady. Thanks for having me.
Good morning. So real quick housekeeping before we get started. It's Mindset Month at Carrot. So go to carrot.com/mindset. You can see our best content, videos, blog articles on how to shape up your mindset, marketing mindset, and a whole lot more. So a lot of good content there. And if you like this content, make sure to subscribe to our podcast, our YouTube channel. And if you like this market harvest, go to carrot.com/harvest, and you can actually get the data report that we're going to be sharing on this show, as well as check out past market harvests. But anyways, something we're going to be talking about today is when will homes become more affordable again? Well, when will housing become affordable again? It's a little bit doom and gloom, but we have Nik from, is it Zonda Homes? Zonda Home?
Yep.
Give me just a little bit of a primer about what you do at Zonda Home.
Sure.
And what Zonda is.
Starting broadly, Zonda is a multifaceted consultancy firm as well as a data provider, the largest data provider in the new home space specifically. So we do a lot of work with huge builders, and in that space, my job particularly, I'm the manager of housing economics. So I work with our chief economist to kind of guide our national picture, and then we also assist on more local projects with local experts and people across the country.
Awesome. Thank you for that. So are you say huge builders, is this single family and multifamily commercial, all of it?
Yeah. So as a company, we work in both. Mine is primarily single family. We have a separate multifamily team out of Texas that handles those big apartment complexes side of the business. But yeah, so primarily like the really big guys like Lennar, DR Horton, etc.
Okay. Awesome. Sweet. So you are day in, day out, deep in data into single family building. That's perfect. Yep. All right. So one of the things we like to go over real quick on the market harvest is the data that we're seeing internally at Carrot, and then we'll jump into our topic for this episode. We'll kind of go over what we're seeing in motivated seller lead trends at Carrot. So if you look at what I'm sharing here, this is the number of visitors, the number of people we have to Carrot sites over the last 30 to 60 days. And so what you'll notice is this slight trend or this slight downward trend from about summer up until now. We're mid-November at the time of recording this. But the number of people visiting Carrot sites has dipped slightly over the last month or so, which is pretty typical as we head into the winter season. Christmas, holidays start to approach, and there's a little bit less people searching. Seller motivation goes down a little bit as it gets colder. Would you agree with that, Tyler? Are you seeing the same thing?
Yeah, there's some seasonality. As it gets colder, closer to the holidays, people just don't want to be inconvenienced or hassled, and they wait until after the holidays if they're motivated to kind of rip the Band-Aid off and come to reality, and things really start to pick up after the first of the year. But Absolutely. It is a good time because motivated seller leads this time of year, the motivation is really, really high if they are reaching out. So I've picked up some really good deals between like Thanksgiving and Christmas time, just because the motivation is a lot higher if they are reaching out.
Interesting. Less leads to weed through. So we're seeing a very similar trend with leads, except for the drop's been a little bit more noticeable from August to in November. The number of leads generated through Carrot sites has dipped slightly over the last 1 to 2 months, which again is typical as we head into winter season, and might be indicative of this housing affordability and availability issues that we're going to be talking about. Because if you're selling your house, what's your next option? That's what we're going to talk about. And then here's a quick overview of visitors by channel, marketing channels. Where are people coming from? So what you'll see here is that the lion's share of visitors are coming from direct. So this is your offline marketing working for you. People entering your website directly, maybe from direct mail, or they, word of mouth, magnet on the fridge, and organic Google search. So direct and organic Google search is dominating for our care members. And direct is your offline marketing efforts. And then we have, paid search, et cetera. And as far as where the most leads coming from right now, very similar to the graph above, you'll see that SEO efforts continue to yield the best results for care members as organic leads heavily outweigh the other sources. So we have organic search is about 35% of the leads that are coming in. Paid search is 22%. So paid search is including Google pay-per-click, Facebook ads like Facebook retargeting ads, etc. And then the smaller ones, we have social, of course, direct in there too. So that's where the bulk of the leads are coming from for Carrot members. And average leads per Carrot member over the last 30 days versus the month before, 12.6, down a little bit, but lines up with the other data that we're seeing right now. So that being said, Nikolas, I want to kick it over to you, man. What are you guys seeing? What's interesting to you guys right now as far as this whole conversation of when is housing going to become affordable again?
I mean, I think it's obviously the number one topic that everyone's trying to understand and come to terms with, is because what we're seeing and hearing is that there is generally a lot of demand in the market. It's just the numbers don't pencil for the vast majority of people. And so it's about kind of when can we get to a point that they do. So the chart on the screen, which shows the median resale single family mortgage payment to income ratio, this is kind of how we refer to affordability rather than the top line prices, because as we've seen over the past 6-8 months, rates really matter. What people can afford on a monthly basis is kind of how, for most people, home purchases are processed. Obviously, the cash buyers are a completely different breed in that sense, but we've vastly surpassed where we were prior to the Great Recession in that lead up. As rates, this estimate is using 7% for the current payment. We're at about 35% median. So that's even in more affordable housing markets. We're at a historically high level. So going forward, we either need to see big price cuts, big rate decreases, or some combination of both to get it to a more palatable place.
And this is average. So what's, give me an idea of like average home price. I'm on West Coast. You're looking at paying maybe $300,000, $350,000 for a 2-3 bedroom, middle-class home. What's average here?
Yeah, the typical median nationally is about 350, 400, depending on the source and what is being estimated. I believe it was about, I want to say, I can't recall 100%, but NAR releases the data monthly of what the median and average home that was sold in the previous month. I want to say it was like high threes, and then the new was mid-high fours, which is reported by the census, so a little bit different, but that's kind of the range we're looking at nationally.
And Tyler, this is you used to be or are a Dave Ramsey coach. What's his rule of thumb? No more than 30% of your income for your mortgage
DTI
payment.
about and a 15-year fixed.
That's
been a real challenge. I mean, that's kind of thrown out the window. But
it was already a challenge, and then this graph, you see it just boom, it just crashes right over the 30% mark.
With home values going up, coupled with interest rates, it's just hard for most people. I mean, the solution is buy a less expensive home or come in with more money or do a combination of both. What we're also seeing a lot of sellers and buyers doing now are seller concessions to either buy down the rate or lighten the load in terms of money that a buyer's got to come out of pocket in terms of offering seller concessions. So seller concessions are starting to come back around, and we're seeing a lot of that now between buyer and seller concessions.
So Nick, I know you have some other data prepared that you'd like to share here. When you want to move on, just let me know. But I had a couple questions for you.
I would like to add something to what Tyler just said about
Yeah, go ahead.
concessions, because concessions are pretty typical even in good times for builders of some kind, because they're competing with each other, whether it's some credit towards appliances or something like that. But now we are seeing a lot of rate buy downs, basically offering some kind of like adjustable rate mortgage over the first 2 years to kind of maybe lower the payment initially, and then in longer term maybe offering the prospective chances of refinancing. Uh, we're basically seeing over 90% of builders that we work with offering concessions now, which is super, super high.
Hmm.
And across all the projects we track, which are about 15,000, 16,000, over half of them are openly marketing concessions. So that's not even when you get in there, if you're working with the salespeople, they're offering you some concessions, openly marketing, which is the highest we've ever seen. Uh, Builders really like to keep that top line price. So when good times come around again, they can start building on that price again. So they offer concessions as a way to kind of maybe close the gap, as Tyler said. But yeah, we're seeing a ton of that.
Has building, what's the speed of building like right now compared to through the pandemic, through all these supply chain issues? Are contractors ramping up? Like, we're still, how many homes are we short? Like 5 million, something like that?
Our estimate is, I mean, everyone's estimate is different. Ours is about 1.5 to 2 million. We're short nationally.
Hmm.
It depends, obviously, how you count second homes and how you count homes losing their functionality over time and stuff like that. So there's various inputs. I personally like the number around 1.5 to 2 million. So we're definitely short. But as far as building goes, it's been really interesting 2 years, 2.5 years in that sense, because we were undersupplied going into the pandemic. And then building crashed for about 2 months as demand came away from the market in that March, April, early pandemic. And then builders were essentially playing catch up as demand poured into all these markets, uh, both from a low starting point and taking their foots off the gas. And then when you add in all the supply chain issues, lumber mills shutting down, uh, various delays from appliances or products from overseas, uh, lead times turned from like 3 months to 6 months, markets that were 6 months or 10, 12 months. So there was all these homes that were working through the process, and they're all starting to come finish about now as demand's pulling out. So it's really interesting that we're seeing this buildup of what we call QMIs, or which are quick move-ins, homes that can be moved in within 3 or so months. So we're seeing that start to pile up. But when you look further out from that, we're seeing builders start to pull back on both starting, permitting, and other homes that are further out in the process. So kind of hedging their risk in that sense. But if demand turns around, will they be prepared again, or will we be entering another situation where the construction is kind of behind the eight ball?
Nick, I've got a question for you.
Sure.
Has there been a fallout rate with interest rates going up and people no longer being able to qualify because of DTI and people just having to walk away?
Super. Yeah. Cancellations are starting to get really high. It does depend on geography more so. Places like Phoenix and Denver and stuff are seeing really high cancellation rates, just because, simply as you said, they'll look at a home, the rates will be what they were when they're looking at it. By the time they get through escrow and all that, the rates may be 100 basis points higher, and they can't afford the payment anymore. So cancellations are rapidly rising. And what builders are finding is early on in the pandemic, you had a cancellation, you're selling the home for more than you had it originally negotiated for. Now there's a struggle to resell that canceled home. So yeah, definitely.
That's wild. Yeah, I would think that. See, I would have thought the opposite, that building would be, picking up just because of the shortage in general, that contractors would sort of push through that despite demand being lower. I would think that contractors would be going after, that the strategy would shift towards cheaper, faster homes. Is that happening at all for the people who are still building?
Yeah, for sure. We call it right sizing, which is essentially building homes smaller, but maybe pricing in a higher per square footage. So you maybe either keep the top line stagnant or lower, so you're eventually bringing down the monthly payment, but you're still being able to pass along increases. Over time, and especially recently, we're seeing the average square footage of home come down, even in markets that are notoriously big builders, like in Texas. Like you're still seeing the average size come down, uh, and it's just a long term affordability play. Is that's just as Tyler said earlier, that's a way that you can kind of accommodate the affordability problem.
Yeah, that's going to be really interesting to see how that plays out over the long term. Because if you look at, since 60s to 70s up until now, average home size just went through the roof. I mean, our home size more than doubled, if I'm correct. And so, but our generation values more that minimalism, smaller, and so it seems to be kind of leveling back out. Anyways, you've got a couple other interesting slides here. I want to toss it over to you, Nick. What's going on here?
Sure. Basically, since we are starting to see price cuts in the market, we wanted to kind of help visualize the average cut needed to return to payments at certain levels when demand was really, really strong. So this is for year end, looking at December 22. I kind of circled the little peak there. On the right, this is our new home pending sales index, which is basically a gauge of the new home market in terms of both volume and rate of sales. In the new home side, builders like to track like how many homes they're selling per project, maybe a little more so than volume, although volume is still important. So we combine them into one metric. The index value is basically a representation of the percent above or below the baseline value. So in December 21, January 22, we were selling about 60% more or faster than we were in the baseline of 2016. And so on the left, looking back over, this is the price cut needed to return to that affordability level based on the rates listed. So at a 7% rate, which we're currently at, actually a little bit higher, we would need to cut prices on average 40% across the country. And as you can see, as rates come down, there is still some affordability relief, but realistically, that level of affordability that we saw at year end is probably not super realistic. So if we click forward to one more slide, this is returning to the level we saw in May. So this is already after rates had started to go up, as well as some additional price increases. But you can see, at least on the new home side, sales were still really strong and at a very acceptable rate. So above where we were prior to the pandemic. This is more in reality. At 7%, we need to cut rates on average, or prices on average 15%. At 6, just about 6 or 7%. And if we get down back to 5% rate, we can actually increase prices again to get back to that level of affordability. I wouldn't necessarily classify the May level as quote unquote affordable, but it is more attainable.
Okay. Yeah, this is a little bit more hopeful, a little bit more realistic, as you said. So what is Zonda seen as like, is there an answer? Tyler, you got your crystal ball. Is there an answer?
Let's see. Throw out that crystal ball and give it to us.
When will homes become affordable again?
It's a good question. I mean, before we started recording, we were talking offline about the lock-in effect, and it's kind of how you get a lot of people to start selling again. Because to get in a more affordable place, you really either need big price cuts, which historically only come with big job losses, which not super ideal because that affects demand as well, or rates coming down. And I don't think rates will be what they were in the boom of the pandemic, sub 3%. And if we do get there, that means something very wrong has happened along the way in terms of our economic output. So really, we just need to weather the current storm in terms of what rates are doing. And as far as the Fed pushing the federal funds rate higher and sustaining or trying to bring inflation down, or we need to consider more right sizing, more infill development, higher density, maybe a smaller square footage where we can bring that top line price down and hence the monthly payment down.
Yeah, there are options. It's just it sounds like we can't. I mean, obviously, it's the definition of insanity. We can't keep doing what we've been. I say we as if I'm a home builder, but we can't keep building homes the way we have been and expect it to turn out well. We've got to explore other options like right sizing. I like that. Tyler, you have any questions? I was going to throw you a question.
No, I mean, I agree with Nick on the investment side. I'm a hybrid agent. 80% of what I do is on the investment side, motivated seller leads. But the big challenge I'm seeing, for the last 2 years, we've had the challenge of low inventory. And so sellers didn't need us. And my leads dwindled just because it was easier for somebody to sell. Now, what we're seeing, like Nick said, is rate lock, where the majority of the leads that we're getting are people that have a vacant home or maybe a rental home, people that aren't living in the home, because people right now that are living in the home that are maybe motivated are less likely to get off a really, really low rate, because now they've got the challenge of potentially having to buy something else. And their rates have gone up 4% since the beginning of the year, which has a huge impact to payment. So the lead flow in terms of the type of the lead, as far as motivated seller leads, the ones that I've been getting have changed dramatically to where I'm not getting a lot of owner occupied leads, but vacants and probate, and people that have inherited a home, and or maybe a tired landlord that has just done with their rental property. So that's what I'm seeing in terms of my lead flow.
Is it changing your strategy at all? Or are you still moving forward with the same strategy?
Well, still moving forward. I've become a lot more conservative. I got hit pretty hard in 07, 08, where I was over leveraged. We had a lot of rehabs going on. And so I'm treading lightly. And to me,
Yeah.
it's a hot potato. It's a musical chair in terms of, everything we do, we buy and sell. We don't do any major rehabs. We hotel a lot of what we do, or we just do light cleanup and then relist in the MLS or sell to an investor. So yeah, I'm more on the conservative side, just because I got hit pretty hard on the last go around. And we've seen about an 8 to a 10% pullback here in my local market in terms of home values. But again, like Nick said, we still have a long way to go in order to get people to a payment that they can afford, and or a debt to income ratio that will allow them to buy homes based on the current prices.
Yeah, you almost need to see double that cut, like
Yep.
double that for it to become more affordable, according to Nick's data.
With pricing, it's really interesting because historically, especially in the existing side, prices are very elastic. People just stay in the home. As you said, most of your leads are vacant home people. With existing homes, until they can't make the payments anymore, people just typically ride out the storm and they just won't cut prices that much. But we saw such a huge equity boom over the past 2 years. So many people have so much runway that I think we'll see prices be cut more willingly when people need to sell, which should be an interesting dynamic. But historically, prices don't really like to move. But I think we will see movement just because so much money was made in terms of their investments over the past 2 years. That gives a little optimism on seeing prices maybe come down on the existing side at least.
Well, it goes back to what you said. I mean, so far we haven't seen any. We started to see layoffs and job loss and things like that. But if that's really what I'm looking at now, is if we start to see a lot of layoffs and people out of work, that's when the motivation really kicks in for people that are living in homes. But the challenge too is on the rental side. Rents have done the same thing. So even if somebody were to sell and they were to go rent, there's not very many rentals, and rents have doubled. So it's kind of, people would rather, it's cheaper for somebody to stay in their home than it is to sell and then go find a rental property. The leads on the people that are living in homes have become a little bit more challenging than those that are vacant, or a landlord that doesn't live in the home. So I've seen the flow change since rates have kicked up.
Well, what's interesting is this doesn't apply to the masses, but I think what you are seeing is the creative options are taking off. And what I mean is, when the pandemic hit and like when rents are high, RV sales and travel trailer sales are going up. Everybody wants an RV all of a sudden because it's changed everything. You can travel now, and if we can't afford rent, well, hey, can we get a trailer to stay at the in-laws place, until things are more affordable again? And with construction, the lumber crisis caused more alternative construction methods like 3D printed concrete homes. That's booming. And so there's a lot of creative options. So I think the people that are willing to explore something besides, hey, let's just go look for another standard stick-built home in the MLS at whatever price it is, Yeah, there's a lot of options out there. Anyways, we're about out of time. A couple really quick things before we wrap it up. We're not going to talk about the headlines, but I want our audience just to know, in case you missed this in the news, in case you're under a rock, a couple interesting things that happened. Opendoor lost nearly $1 billion in Q3. Yes, that's billion with a B. So we'll put a link in the show notes. You can go check out their financial reports. Tyler, I said we aren't going to discuss it. I'll ask you real briefly. Any thoughts on that? It's wild.
Well, it is wild. I mean, Zillow already cut bait and they got out of the business. Redfin's doing the same. And, I've been saying for years, it's not a matter of if, it's a matter of when. I mean, they just can't sustain the business model. And a lot of their inventory was purchased back in May, June at the height of the market. And a little bit of a pullback, which we've had. I mean, I don't know. To me, the economics of their business model just does not make sense. So it's good for smaller investors over time. I mean, to me, it's a good thing for people like myself that have had to compete with the big boys. So it's going to play out, and I just don't think it's going to end well.
Power to the people. I mean, obviously, I said power to the people. It's not to, I don't want to dismiss. A lot of people are losing their jobs. If you're working for Opendoor or Redfin, Redfin, that was the other headline. They got out of the house flipping business. Right. But, that sucks if you're in that.
Well, and Zillow timed it perfectly. When they announced getting out, they still had a couple months of runway to get rid of a lot of their inventory, which they were able to do. And that was back in the spring before we actually had the pullback. So their timing was perfect in terms of them doing what they did and being able to still get rid of stuff without a huge loss.
Yeah, that's a good point.
We recently looked at the iBuyer data just over time, like historically, like how much share they made of the market and the volume. And they're basically accounting for all of them, obviously, they pulled out about 20% of the peak they were doing in volume.
Yep.
So it's just not a huge surprise to hear that Opendoor number, even though it is super shocking hearing a B next to it. Which is interesting, though, because you're seeing other big investors move in, but their model is a little bit different, where they're buying to rent through maybe the more term, like the painful period. And then once homes start appreciating again, they can get the price appreciation and then probably cash out. But you have to be super well capitalized to do it. But you're seeing people start to position themselves for that.
The other bigger good news from, if you're an agent out there, our market was 25 to 30%, but they list their own stuff. So agents on the listing side were struggling, but with the iBuyers going away, it now opens up a lot of opportunities for agents because there's going to be a lot more listings to be had.
Tyler's over in Tucson just throwing a party right now. This crystal ball.
So it's
finally.
At the end of the day, it's a good thing for agents and the smaller investors.
Yeah, it's encouraging for you guys. Less competition. All right, well that's it for the show. Just kidding. We're bringing back tips that actually work. This is something we did on Behind the Deal. So if you've been following us for any length of time and you were with Carrot for Behind the Deal, we did tips that actually work. And so we want to give you guys listening just a really quick tactical tip, something you can implement in your business. They're usually around marketing, something you do to your website, pretty tactical or technical. This one's a little bit different. It's actually a quote. A recent Carrot camper came out to Carrot HQ and shared this quote from Mark Twain. I love it. It's stuck with me the past month or two, and it's worked for me. I'm going to botch it, but here we go. It's if your goal is to swallow a frog, then swallow it first thing in the morning. If your goal is to swallow 2 frogs, then swallow the bigger one first. And so I say that because I know that a lot of people listen to this podcast, myself included, have a hard time focusing, prioritizing. There's always a million shiny things going on. And so tackling that really hard thing first early in the day and getting it out of the way gives you a serious amount of momentum. And then when you're overwhelmed, if it's like you got 2 big things in your plate, 5 big things, take the biggest one first. It's just really simple. So I love that quote. My wife and I was joking about, like, what do we do? Well, what's the frog? Which one's the frog? Swallow the frog. So anyways, hope you guys enjoy that. Thanks for listening, everyone. Make sure to subscribe to the podcast. Share this with a friend if you thought it was valuable. And we'll see you on the next Market Harvest. Tyler, Nick, thank you guys so much for hopping on and sharing your wisdom with the audience. Appreciate you guys.
Thanks for having me.
Yeah, thanks for having me.
We'll see you guys. Yep. We'll see you guys later.